Hello again, everybody. Dr. Richard Smith here with Cycles TV. Today is what? It's October. Unbelievable. October the 7th, Tuesday, October the 7th, 2025. And just want to say thank you to all of the new viewers who joined us over the past week, especially those of you from the David Lynn report. Appreciate David having me on and appreciate the interest from his community. Please do subscribe and join our YouTube channel. We produce, I think, some of the best free content online, period. And we do it out of our not-for-profit Foundation for the Study of Cycles. So we really appreciate your support. We appreciate you telling your friends, sharing our work, and subscribing to what we do. So last week, we kind of went deep and it hasn't stopped since then. So we're going to continue to dive into how the world works today, what is going on in our financial system and our economy. Because, why does this relate to cycles? Because how the world works impacts what cycles we see in the markets and also how the cycles manifest in the market. So I think that what I'm exploring and uncovering here explains a lot just from the point of view of how to make sense of what's happening, but also how we should be looking for cycles in markets and why they tend to kind of have the shapes that they do of late. So that is something that I want to explore and then I'll get to at the end here. So thanks again for joining us. Probably be 45 minutes again today, getting into stablecoins, Stargate, and shadow banks. So let's dig in. All right, let me get things set up here. I'm going to first just jump back to what we looked at last week here. And yeah, okay. So this is what got me started last week. This was the Federal Reserve balance sheet, back from 1984 into early 2000 here. And we can see that it ranged from $40 billion down to as low as $4 billion. $4 billion on the Federal Reserve balance sheet in 2004. Then we had the little blip of 9/11 and some, I'm not sure what we did back then, but the balance sheet expanded. I guess, we bought some more treasuries to try to reassure everybody that it wasn't the end of America. And so that was a wild spike from, 4 or 5 billion up to 64 billion. And then all kind of went along 2007, 2008. And then the great financial crisis hits, right? And financial institutions are in danger of going under. And all of a sudden, the former balance sheet of the Fed ranging from 5 billion to this spike here of 65 billion goes up to $1 trillion and then 2 trillion. COVID hits and the Fed expands its balance sheet even more, which is basically buying the assets like treasuries and mortgage-backed securities from the banks and giving them reserves in return, and then supporting the direct payment to people during COVID. So went from 4 billion up to 4 trillion. That is a 1,000-fold increase. So this is clearly a different era that we're living in. Started with the great financial crisis, has some origins a little earlier than that. but this defined a new reality in the financial markets and continues today as the private sector starts to pick up and mimic the same practices done by the Fed and Treasury. And now we have it with shadow banks and OpenAI and stablecoins, all part of this financial engineering regime. So that's what we're going to look at today. Just briefly, we can't do a whole lot in a half an hour, but I think it's a very important thing to understand. And I think it does explain some of the behavior we see in cycles today. So with that, give me just a second here, and I'm gonna jump over to my PowerPoint and go through this thesis that I'm still working out. So I can use your help here, anybody with expertise, but this is what I'm seeing as I try to sort out, again, how the world works today, what we're experiencing, what's going on, how to make sense of it all, how to allocate our own resources in the midst of it. So again, like I said last week, I'm a little bit out over my skis here, so forgive me if I make some mistakes, but I think the broad strokes are true, and look forward to your feedback on this. So let's go. All right, so in our old world, the pre-2008, we had a banking system with scarce reserves, right? As low as 4 or 5 billion at the Federal Reserves. The banks themselves did not keep a lot of reserves. And then the 2008 great financial crisis hit, and there weren't enough reserves in the system, and the Fed engineered reserves into a new era. But back then, pre-2008, monetary policy was pretty simple. We just had the minimum cash reserves, and we had the Fed funds rate. So the Fed adjusted the flow of cash with small, predictable sales purchases of short-term debt. The Fed would either buy treasuries or sell treasuries, collateralize with the banks, but in very small amounts. And so we have the Fed funds rate, and that's the target rate. And then the Fed keeps the rate at which banks lend to each other at that target rate by buying and selling treasuries. That was our world before 2008. And then in this new world, it's no longer monetary policy. It's really monetary engineering, financial engineering, because again, now we're moving beyond fiscal policy into fiscal engineering too. Just briefly, what's the difference between monetary policy and fiscal policy? Monetary policy is what happens with the money, right? Interest rates, money printing, reserves, Fed buying and selling assets. And fiscal policy are things like taxes and taxes, stimulus from the federal government, et cetera, right? So we've really moved from a world of, simple policy, like turn the faucet on, turn the faucet off a little bit, to now we're in a very complex engineered system with massive reserves in the banking system. So from policy tools to system design, in the 1980s to 2000s, the central banks were really referees or umpires. They weren't in the game. But then with 2008 financial crisis, we actually took on those assets and mortgage-backed securities for the first time in the history of the central banking, and became a participant as well as a referee. So now the umpire is calling balls and strikes on himself. I do really believe that this was the institutionalization of moral hazard. What is moral hazard? It's essentially privatized profits and socialized losses, right? The Fed when it took on all those treasuries and mortgage-backed securities, essentially said, you know what, we're going to take the risk so that you private banks don't go under. And then that idea of privatized profits and socialized losses has metastasized, and I do use that word carefully, basically into what we see today throughout the financial world, and that we're going to get at when we look at Stargate and shadow banks and stablecoins. Again, today, we don't have policymakers, we really have engineers, both on the monetary side and on the fiscal side. Markets no longer self-correct. They are administered markets, not free markets, administered markets through engineered feedback loops, QE, repos, fiscal stimulus, and Fed mechanisms like interest rate on deposits and reverse repos. So this is how the financial world maintains itself today. And this all started back in 2008 and has continued for, 17 years now. So privatized profits, socialized losses, kind of got a hint of it with the long-term capital management rescue back in 1998. Fed put gets going, went on ballistics in 2008 great financial crisis, right? It was just save the system, whatever it takes. And then with COVID, liquidity for all, risk for none. So this has really been building step by step, right? And I mean, there's no real indication that the system is likely to change here anytime soon. When downside is public and upside is private, risk appetite becomes infinite. That's the moral hazard story. So we've moved from public financing to private infrastructure. Right? Fiscal engineering in the wild, public balance sheets, Fed Treasury, inspired private finance models. Okay. And today, capital looks for mission assets. This is really interesting to me, that mimic sovereign risk. So you hear about these massive projects, right? Remember the green economy that we were all supposed to be building 10 years ago? That story wasn't enough to sustain it. So today we've got the AI story. And it's really a mission story that kind of invokes the whole infrastructure of the public and the private sector so that everybody believes, oh man, this has got to happen. This is going to happen. We've got a credible story that just allows the whole machinery of this financial engineering to keep going. That's what gives these stories such power. Defense has been a traditional one, right? But hey, World War III hasn't happened. So, it's kind of moved to the digital and monetary world, frankly. But these big stories, we need these big mission-driven stories that really kind of give some justification to the public backstop basically being invoked to allow the private sector to take risks that it otherwise wouldn't be able to take. So Stargate, I mean, just yesterday we had a huge deal announced between OpenAI and AMD. Again, well, let me not get ahead of myself here, but we'll get to it one by one. Stargate, stablecoins, and shadow banking channels now reproduce state financing logic. All right, so let's talk about Stargate. I mean, since Stargate is the one with SoftBank and OpenAI and Oracle, right? We're going to build out all these data centers. Massive public-private infrastructure program announced in the White House, as I recall. building out data centers, gigawatt data centers, powered by a gigawatt of electricity at $30 to $50 billion. I've kind of had ranges of 20 billion to 60 billion. So I put 30 to 50 billion in here. But to build out a 1 gigawatt data center of the kind that's being planned is at least $30 billion of real money that's got to go into building it and buying the computers, the chips, the infrastructure to make the whole thing run. It's financed like a sovereign project with vendor equity and private credit and long-term contracts. As it does this, it continues to absorb liquidity. It creates duration, right? It's a long project. It's going to go on for like 20 years. So we're going to have loans going out for 20 years. And these data centers are going to be, infrastructure resources that are like toll roads that they just keep, and utilities, they just keep producing year after year once those initial costs are in, all under an implicit national security backstop. So AI and AGI in particular is the new green economy, an engineered collateral sink. When I say collateral sink, okay, collateral. We've talked about collateral for the last couple of weeks. If you're going to get a mortgage, you put up your home as collateral, right? But meanwhile, in the world we live in today, it's not just the things like our homes that are collateral, or our bank accounts. It's the treasuries, and all of the debt becomes collateral for more debt. And so the whole system continuing to flow is the main thing that needs to happen, right? Especially as not just the Treasury and Fed do this, but we get the private sector coming in and doing this. And in the case of Stargate, what is the collateral here? Okay, so you got SoftBank, you got Oracle. They've got some money, yes, not enough to pay for one of these data centers outright, but they also have room to take on debt, to issue bonds, to create more debt and more liquidity in the system. OpenAI really doesn't have money. They've raised some capital, but not nearly enough to cover these costs. And OpenAI is kind of the linchpin here of all these deals. The one that got done with NVIDIA recently for $100 billion that is, going to be doled out in tranches, maybe $10 billion per gigawatts data center that NVIDIA is going to be actually, writing a check for to help build part of that data center. But then OpenAI's got to find the money to buy all the chips from NVIDIA that it agreed to buy. So it's quite a circular, relationship going on here. It's really an engineered relationship. And the big collateral here is OpenAI's growth and their brand, right? So that's the linchpin that's making everybody go, maybe this can work, right? Well, maybe it can work, but really it's got to work because the system needs it to work, because the system has to keep this flow of debt and collateral all working and flowing, or else the thing falls apart. So that's one aspect of how we're starting to see what the Fed and Treasury did back in 2008, manifesting in financial markets too. Stablecoins. Now, this is an interesting one and frankly, a little painful one. The private dollar system. So stablecoins like Tether and Circle. We just had the Genius Act passed, right? Regulation of the stablecoin market. Well, that regulation of the stablecoin market requires companies like Tether, when they get dollars, to buy treasuries so that they have safe assets that back up their dollars, right? The Genius Act requires Tether and other stablecoin issuers to buy US treasuries. So the rails of the digital currency ecosystem are running on US treasuries. Bitcoin was supposed to be the alternative to the fiat money system. And I know Bitcoin is not Tether, but Bitcoin is obviously a huge beneficiary of this Tether treasury system. Tether's taking dollars and it's buying treasuries, right? Who else exchanges dollars for treasuries? The Federal Reserve. Tether is an unregulated bank, and it's bringing liquidity from dollars into digital dollars and securing those digital dollars with US treasuries. And those digital dollars are going into digital currencies like Bitcoin. Bitcoin as the alternative to fiat currency is seriously undermined by the reliance on treasuries of the stablecoin system. So private issuers mimicking Fed's balance sheet logic, par, convertibility, duration, transformation. Redemptions equals forced treasury sales and funding stress, right? If the treasury system comes under pressure, Tether's going to come under pressure, Circle's going to come under pressure, liquidity is going to get drained out of the digital system, and that's going to impact prices of things like Bitcoin and Ether too. Stablecoins are the shadow central banks of fiscal dominance, right? They're actually they're creating more demand for treasuries, and they're moving that demand, away from the Fed and into the private sector. And that is generating liquidity in the digital currency space that is benefiting things like Bitcoin and Ether. All right, now shadow banks, the new dealers, right? So this is Apollo and BlackRock. Okay, they're not Bank of America. They're not even Goldman Sachs. Private credit, right? You heard of private equity. Well, now we have private credit. Money market funds, insurers, asset managers now perform liquidity transformation, right? So they fund real assets like AI and infrastructure with repo financed or collateralized structures. In all of this, there is implicit faith in the Fed and Treasury to stabilize the collateral, because the most important collateral in the system is treasuries. This is moral hazard squared. The system's plumbing is now outsourced, but still publicly insured, right? What does it mean when Tether holds the treasuries instead of the Federal Reserve? What does it mean when Apollo is, putting together deals for data centers and private credit and buying, an insurance company so it can use the float, and then reinsuring its liabilities in the Cayman Islands where we can't see what's going on? And, if you think about it, in all these things with stable coins, with Stargate and these deals that OpenAI is doing with shadow banks, it's all dark in the sense that we can't see what's going on, right? We don't get to audit Tether. We don't get to see what is inside Tether like we get to see what's inside the Federal Reserve. We don't get to see what OpenAI is doing and what its finances really are. It's a private company valued at $500 billion as a private company. We don't get to see it. When Apollo buys Athene, Athene is the insurance company, like life insurance policies, et cetera, right? And then uses the premiums that the insurance customers pay to make new investments and then takes those liabilities and puts them offshore where we don't get to see what the real financial conditions of the reinsurers are. So in all of this, we see more and more opaqueness, more and more opacity that obscures our ability to really understand what's going on. So all of these operations are moving from the public sector to the private sector. And the private sector has ways of avoiding the scrutiny of the regulatory system. So this is the world that we're living in right now. Private financing copying the public blueprint. Fed and Treasury engineered liquidity, quantitative easing, reverse repos, standard repos. Private actors mimic these mechanisms on their own, all with the kind of implicit backstop of the Fed Treasury, because we can't afford for the system to collapse. And, the Treasuries continuing to be accepted as collateral is the heart of this system. And that means that, the Treasury's got to keep their liquidity going, because if they don't have their liquidity, they're the benchmark for everything else. Then the whole system starts to really come into doubt. And really, the fact that Treasury is able to still issue so much debt and have it be liquid and used as the safest form of collateral keeps all the other interest rates low too, and allows these private entities to mimic what Treasury and the Fed are doing, because their rates don't get too far away from Treasuries. So collateral, not productivity, becomes the growth engine. And we get into a circular loop of policy engineering, private mimicry, and more policy engineering. Each layer assumes another layer will be rescued. Moral hazard migrates from banks to corporates to entire asset classes. Innovation now follows subsidy, not necessity. And collateral, not productivity, as we said, becomes the growth engine. And the economy now innovates around the guarantee of rescue. So I think that is a pretty reasonable picture of how it works. I don't know when it ends. I don't know if this can keep going on forever. I'm not privy to the inside and what's really happening. And when I look at it from the outside, it looks very concerning. Meanwhile, some hint of this has been present in markets for my entire time in markets. And here we are 30 years later, and the world still hasn't fallen apart. There are people who think this can't go on forever, and they're at major institutions and banks. So maybe it can. It doesn't make sense to me. And I don't particularly like the incentives of the system, but that's not really relevant to whether or not we're going to continue to live under this kind of regime. So, impact on cycles and price discovery. Okay. So, engineering versus emergence. In this kind of environment, right, it's all about dampening the market cycles, because we're engineering the cycles away. But as we're seeing here in this example, right, moving from 2008, well, let's go back to 1998 and long-term capital markets getting bailed out, and then 2008 and the great financial crisis, and then 2020 and COVID, and then today we've got now the private sector getting in on this game of financial engineering, all kind of on the bedrock of treasury issuance and treasuries as collateral, and the whole system continuing to function and flow. But feedback control reduces volatility until it fails catastrophically, right? So price discovery is suppressed by moral hazard and policy reflexivity. And I think we've seen this in the markets, certainly since 2008, right? Everything kind of goes along, and then all of a sudden there's a huge shock, right? I mean, if we just look at the most recent one, let's take the Liberation Day correction from February, 2025 to April 2025, right? We got a shock. And then when it got apparent that that shock was in danger of actually destabilizing the system, we kind of walked it back, and we've been in a relentless, nonstop rally ever since. Look at the COVID crisis. You get these sort of extended cycles and then sharp corrections and then a policy adjustment and a rapid recovery. That's what I think the impact is for cycles. And I don't think, well, I'm not going to say we don't have true price discovery now, but I think we have to reconsider what price discovery really means. What is a price today in this financially engineered environment? What is the typical behavior of prices? It's not just, like a capitalism where you got a business and somebody comes in and looks at your business and says, well, for every $1 you spend on your business, I see you earning $1.20 on your business. So you're making 20% profits. And, I think I can invest in expanding those profits. No, that's not the world we live in now. Right? That's the old price discovery world. Today, price and OpenAI and stablecoins and shadow banks, no, it's not price in the kind of way we're used to thinking about business and capital. This is a new era. So that's the picture that I've been able to put together so far. I'm continuing to work to understand this. I do think it has an impact on how we study cycles, how we understand markets, how we forecast. And it has an impact on our own sanity too, because it really doesn't make a lot of sense from the way, compared to the way we used to understand things. We have to understand that we're living in a different regime with different rules, different incentives. And that's how we make sense of it, And when we don't understand that, it's kind of anxiety inducing, right? If we don't understand how the world works, we get uncomfortable and confused. So I think this is how the financial world is working and the economy is working. It's why we see more and more concentration of, gains in the stock market, wealth in the 1% and the 0.1%, power in federal governments, central banks. Let's see what's on your mind. All right. All right, good to see everybody from around the world. DR's in South Africa. When are you coming back, DR? I hope you'll be back soon. Wales. Also South Africa. All right. Musk, Zuckerberg, Bezos, Thiel, Altman, Gates, Page, and Brent, Ellison, and many others are intelligence agency operatives who work directly with the government. Seems plausible. They're certainly partners, right? I mean, I don't know. I'm trying not to get too conspiratorial here. I'm really trying to report the facts. The facts as I'm able to see them and understand them, and resist going too far down rabbit holes. All right. See, we had some sound issues, but it seems okay. Palantir has profit to earnings ratio of 500-1. Well, Peter Thiel. All right. I hear you, Dancing Shiva. I'm not going to argue against you. Thanks, Time-O Money. All right. How do recent developments in stablecoin regulation and the rise of shadow banking influence the reliability of traditional market analysis? That's my question too, Ahmed. Thanks. I hope I've answered it a little bit. I do think we have to take this financial engineering element of how the markets and economy work today into consideration in our cycles analysis. And I think in particular, it means that we're going to kind of get extended cycles followed by sharp corrections and sharp reversals until there's not a reversal. But, you know, maybe we're getting there. I don't know. UAE, welcome. I think that's Brazil. Yeah, I'm sorry if I'm wrong about that. Have we had the situation before in the world at any time? Can the debt markets force a higher yield, causing debt for countries and private markets to lose control of the system? It's possible, but you know, at this point, what's so hard to see through is that all of the players are essentially incentivized by the same thing, which is just to keep the system going. Think back to 2008, right? I mean, sure, there were some casualties. There have been casualties throughout the past 25 years, right? Enrons and Bear Stearns and Sam, what's his name? Not Sam Altman, but the other Sam Bankman-Fried. That's the thing I don't understand is what really might cause the system to really fail, as opposed to keep digging itself out one way or another. No worries, Dancing Shiva. You know, like I said, it's a confusing time. I understand that people are confused and that we're trying to make sense of things. I think that's what human beings do. I encourage us to try to look at the data, try to understand what's happening. I always like the, I don't know who said it, but, you know, human stupidity as an explanation over conspiracy has always had a ring of truth to me. Are stablecoins going to allow crypto to move towards an M1 asset? And will that start to generalize the use of cryptocurrencies as a means of buying everyday things? Possible. I don't know. You know, I would love some help on this. I'd love to understand it better. I'm going to continue to try to understand it better myself and to share what I learn with you and to continue to put it in the context of cycles, because I do think there's, from a big picture here, the artificiality of the whole thing and the artificiality of artificial intelligence. It is a concern to me. I don't think it's going to be able to continue forever. And I think that the foundation for the study of cycles was inspired by natural cycles. They've been around a lot longer than these artificial attempts to manage the cycles. We'll see. We're going to have to keep an eye on it. We're going to have to look for indicators. That's what I've been doing, right? And the SOFR and the IORB rates, and looking at treasury auctions, trying to understand better these deals between OpenAI and NVIDIA and AMD and Oracle and SoftBank and how they work, so that we can look for, what would be the real world events. And there will be real world events that would cause these narratives to start to lose traction. I mean, look back on the green economy narrative, right? That has lost traction. Remember all the exchanges, the carbon exchanges we were going to have? Electric vehicles were going to save us. We need to subsidize them. And now it's like, nah. Well, a new story came along, AGI. So maybe this one will go on for a while, and then maybe a new story will come up. Hopefully it's not the story of World War III. Now I'm getting conspiratorial. All right, gang, that's enough for today. Appreciate you sticking with me on this and digging into the details with me, letting me do this work and share it with you, because I really do want to understand what's happening here. We will continue next week and get back into some more concrete cycles work as well. So really appreciate you tuning in and sticking with me and getting down into the weeds and working together to understand our world and our markets and our economy. Thanks so much. I'll see you again next week.